Welcome to this explainer. Today, we're putting Safety Insurance Group through the ultimate valuation gauntlet. We're going to play financial detective, running the stock through the legendary investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, and then backing that up with some hardcore quantitative modeling. Is this stock a hidden gem, or is it a classic value trap? Let's dive right in and find out. Here's our roadmap for the stress test. We'll start with a quick company snapshot, then view it through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll run some DCF and alternative models, and finally wrap up with our synthesis and final verdict. All right, part 1. Company snapshot. Let's meet our contender. We're looking at Safety Insurance Group trading on the NASDAQ under the ticker SAFT at exactly $75.21. So who are they? Basically, they're a regional property and casualty insurer operating primarily up in Massachusetts, New Hampshire, and Maine. If you look at their premium breakdown, they're heavily anchored by private passenger auto. That made up nearly 56% of their direct written premiums in 2024. The rest is mostly filled out by homeowners and commercial auto policies. Now, the financial dynamic here is super interesting. At $75.21 a share, they're boasting a very solid 4.9% dividend yield. That's a $3.68 annualized payout, which definitely catches your eye, right? Plus, they have a robust total equity of $855.7 million. But here's the massive headwind. Recent severe winter storms in the Northeast absolutely battered their first quarter of 2026. We're talking over 1,600 property claims, resulting in $42.7 million in damages. That storm damage literally dragged their earnings down to a net loss of $14.3 million or 99 cents a share just for that quarter. So we've got high dividends mixed with extreme volatility. Perfect stage for a valuation test, wouldn't you say? Moving on to part 2. The Warren Buffett lens, where we're searching for that economic moat and a solid margin of safety. Okay, you know Buffett loves businesses he can predict. Running SAFT through his checklist, well, their economic moat is pretty weak. Sure, they have a great regional focus and an established independent agent network, but auto and home insurance, that's largely a commodity product driven by pricing. Management, however, gets a pass. They're honest and have a fantastic track record of paying and growing that dividend. Debt levels are a massive pass, too. Just $50 million in long-term debt against over $855 million in equity. That's rock solid. But here's where the wheels fall off for Buffett. Earnings consistency and return on equity. Because their earnings are entirely weather-dependent, as we saw with those Q1 winter storms, they fail these crucial metrics hard. So the real question is, at what price would Warren Buffett actually buy this thing? To calculate approximate owner earnings for a stock this volatile, we kind of have to make an assumption. Taking the current price of $75.21 and their trailing PE ratio of 17.4, we get an implied baseline earnings per share of about $4.32. But listen, because this business lacks a durable moat and has so much weather risk, Buffett would likely ignore earnings multiples altogether. He'd look straight at the balance sheet and demand a steep 30% discount to their Q1 book value of $58.28. Applying that margin of safety, Buffett's trigger price to even look at SAFT sits right around $40. That is a massive discount from where it trades today. Let's pivot to part 3, the Peter Lynch lens, focusing on growth at a reasonable price, or GARP. As you might know, Lynch loved to categorize companies into 6 specific buckets. FIFT operates somewhere between a cyclical and a stalwart. Insurance goes through hard and soft pricing cycles, and it's heavily tied to unpredictable, catastrophic events. Lynch's absolute favorite metric was the PEG ratio, price to earnings divided by growth rate. We know their PE is 17.4. Given that this is a mature, regional insurance company in a saturated market, if we assume a fairly generous long-term growth rate of, say, 2%, we calculate a PEG ratio of 8.7. And that 8.7 number, that perfectly illustrates why Lynch would likely walk away. A PEG ratio under 1 is what you want. Anything over 2 is generally considered expensive. So 8.7 is just dangerously high for his tastes. Now, SAFT absolutely passes Lynch's requirement for a strong balance sheet. They're holding a massive $1.3 billion in fixed maturities with very low debt. But Peter Lynch's golden rule for cyclicals is to buy them when PE ratios are low and things look grim, and sell when PE ratios are high. With a 17.4 PE against sluggish growth, Lynch's verdict here would be a firm avoid or sell. All right, part 4, the Benjamin Graham lens. Let's run through the defensive investor checklist. Graham was all about protecting the downside. So how does SAFT do? Actually, it performs admirably on several fronts. Adequate size? Pass, they've got a $1.1 billion market cap. Strong finances? Pass, debt is basically a non-issue. Dividend record? An easy pass, paying consistently for over a decade. Moderate price-to-book ratio? Pass again, a 1.29 times, which is comfortably under Graham's strict 1.5 maximum. But it stumbles on two critical make-or-break rules. Earnings stability fails due to that recent Q1 net loss, and a moderate PE of less than 15? Fail, because as we know, it's sitting up at 17.4. Graham also gave us his classic intrinsic value formula, the square root of 22.5 times the earnings per share times the book value per share. If we plug in our implied EPS of $4.32 and the Q1 book value of $58.28, the math spits out exactly $75.27. So what does this mean? It means at today's market price of $75.21, SAFT is trading exactly at Graham's intrinsic value, literally zero margin of safety here. To get a standard 30% Graham margin of safety, the stock would need to drop to around $52 a share before he'd even consider touching it. Moving on to Part 5, DCF and Alternative Models. It's time to run the hard quantitative math. To build our discounted cash flow model, we have to make some explicit assumptions based on the industry data we have. Since we don't have exact management forecasts for the next 5 years, we're going to use that $4.32 implied EPS as our base cash flow proxy. We project that out for 5 years, calculate a terminal value assuming a mature 2% perpetual growth rate, and then discount it all back to the present using an 8% weighted average cost of capital. That 8% represents the risk and cost of equity for an insurer like this. This specific setup mirrors the base case intrinsic value estimate provided by the Simply Wall Street quantitative analysis in our sources. When we crunch those numbers, the base case intrinsic value lands at $63.67. Take a look at the sensitivity table. Even if we give the company the absolute benefit of the doubt, tweaking the discount rate down to 7% and bumping the growth rate up to 2.5%, the fair value only reaches $79.80. But in our most realistic base case, the stock is currently trading at an 18% premium to its future cash flows. Let's try another model, a comparable company analysis. You always have to look at the neighborhood a stock lives in, right? SAFT trades at 17.4 times earnings. The broader U.S. insurance industry average, just 11.8 times. Even its direct peer average sits slightly lower at 17.1. Bottom line, you're paying a significant premium for SAFT's earnings compared to simply buying a basket of average U.S. insurance stocks. That is really tough to justify, especially given those recent weather-related earnings misses. And just to be incredibly thorough, let's run a dividend discount model, or DDM. This values a stock strictly based on the present value of its future dividend payouts, which is highly relevant here since that 4.9% yield is a huge draw for SAFT. We take their forward annual dividend of $3.68. We assume that same 8% cost of equity and a 2% long-term dividend growth rate. The formula yields an implied fair value of $61.33. So once again, a completely alternative model confirms the exact same narrative. The stock is currently overvalued. All right, Part 6, Synthesis and Final Verdict. Let's look at the analyst's scorecard. Looking at our master summary table here, the picture is honestly pretty undeniable. Nearly every single valuation framework suggests that SAFT is currently trading above its intrinsic value. Buffett demands a massive discount down to $40. Graham says it's fairly priced right now, offering absolutely no margin of safety. The discounted cash flow model puts it at an 18% premium, the dividend model at a 22% premium, and against industry peers, it's trading at a staggering 47% premium. So let's break down the final verdict. The strengths are definitely real. They have an excellent balance sheet with a massive fixed maturity portfolio, a consistent and juicy 4.9% dividend yield, and a very strong market share in Massachusetts. But the risks? They heavily outweigh the strengths right now. You've got severe weather-dependent earnings volatility, like that $14 million first quarter loss, coupled with a high 17.4 PE ratio. You're essentially paying a premium for unpredictable performance. If you are an investor utilizing the strict value frameworks of Buffett, Lynch, and Graham, this is a clear sell at current prices. Now, the only exception is if you're purely an income investor who already owns it and you're willing to stomach the volatility. In that case, you might hold simply to collect that 4.9% yield. Which leaves us with one final provocative thought to consider. When assessing an insurer in today's climate, you have to ask yourself, is capturing a 4.9% dividend yield truly worth absorbing the cyclical risk of increasingly severe, unpredictable northeast storms? Or, by ignoring the models and chasing the yield, have we just identified a classic value trap? Think about that as you review your own portfolios.